welcome back to the corporate finance, the first class. Let's continue to the buy side of the financial system. We already talked about the creation of the financial assets to turn the real assets to financial assets, which are a bunch of legal and financial contracts. So the sell side companies, the investment banks, they create the financial contracts and they sell them to the buyers. The buyers, the buy side, persons and companies who can buy the financial assets. Anyone who has money and who think the price is okay. Most of in the mature financial system, most of the buy side companies, buy side players are institutions, not natural persons. The buy side companies mainly include mutual fund, hedge fund, private equity, and some others. Mutual funds are huge, and they're probably the largest buy side players in the companies in the financial system. Not the players, because a government can also be the buy side institution. For example, Chinese or the Japanese government is the largest buy side or buyer of the American Treasury bonds. No company can be comparable to the Chinese government. So we say the mutual funds are probably the largest buy side companies. What do the mutual funds do? The mutual funds collect the investors' money. How do you invest in the mutual fund? How do you do this? You sign the contract with the mutual fund, you give the money to the mutual fund, and the mutual fund gives you a bunch of return contracts, and you both sign the contracts. Of course, currently in the financial market, everything is electronic. For example, the mutual fund promises that it will use your money to buy a portfolio. A portfolio is a collection, a basket of assets. Like a mutual fund will say, we will divide your money into 300 pieces, 300 parts. And we use each part to buy one stock in the Chinese market. So we in total buy 300 specific stocks. And we tell you in advance, before you give us the money, we tell you this list. We will use your money to buy these 300 stocks. And in the future, if the stock price is going up, we will give you more money. If the stock price is going down, we will give you less money. Okay. Of course, we will charge you something because we provide the service. And our service is valuable. Why? Because if you have, say, $4,000, and how do you buy 300 stocks to diversify the risk? You cannot do that. You only have $10 or $13 for each stock. You cannot buy a stock. As a mutual fund, we collect 1 million investors' money. So we have a huge amount of money together. And we use this huge amount of money to buy the 300 stocks. And you, with $4,000 invested in this mutual fund, has a share of this mutual fund. And at the end, we have the money invested in the 300 stocks. And in 1 year or 2 years, we divide the value of this the mutual fund into different parts and give you the part that you deserve. And we charge some fees. Okay. This is a mutual fund. The largest mutual funds in the world like Vanguard, State Street. So how much money do they have? Several trillion dollars. A lot of money. A lot of money. Of course, this is one mutual fund company. You have to distinguish the mutual fund company between the mutual fund company and mutual fund. A mutual fund company can have, say, 2,000 mutual funds. For one fund, it collects some money and invests in 300 stocks. The other fund collects some money and invests in the several European governments' treasury bonds. And this, another fund will divide your money into two parts. 30% of the money will be used to invest in the stocks, and 70% of the money will be used to invest in the bonds. So they have different mutual funds for different purposes to serve different people with different demands. For example, we know that stocks are riskier than bonds. If I'm an old person, if I were 70 years old, making too much money is not very meaningful to me. So I just want my money to be safe. Okay? With some stable growth of the value. So I'll just ask this mutual fund, say, do you have some product, some portfolio that can invest my retirement fund into the government bonds, especially US government bonds or some other government bonds that are largely safe? You say, yes, we have this. We have this product. Some 50-year-old mid-aged man said, making too much money is not very meaningful, but I still want to make some money. And I can bear some risk. Then the mutual fund says, okay, we have a service. We have a fund that invests 20% of your money into the riskier stocks and 80% of them into the government bonds. So, likely, you will make, if the stocks value is going down, you will lose some money. But you still have 80% invested in the government bonds. So, in total, you do not really lose a lot of money. It's relatively safe. If you're 20-year-old, you say, I can bear the risk. Even I lose everything, I can work again. I can earn the money back. I want to invest in very risky assets. Say, okay, let's invest in Zimbabwe stocks. So the mutual funds provide different services, different funds for different people with different demands. They also include pension fund. So pension fund is really, really large. In every country, although you're students, you're undergrads, so you do not worry about this. But in a lot of countries, not every country, not probably every country, but I don't know. Pension funds collect people's pension for retirement use, the money for use after your retirement pension, and put all of this money together and invest in something. Okay, this is one kind of mutual fund. Insurance firms also have a lot of money. They have their own mutual fund, or they invest their money into the mutual fund. And the mutual fund help the insurance firms' insurance money to invest in some assets. They also have the index funds. And the specific kind of index fund is called ETF, Exchange Traded Fund. Exchange Traded Funds. So this fund is a no person managed fund. In some mutual fund, you have the fund manager. The manager will use their knowledge, professional knowledge. Of course, they charge fees to compensate their professional knowledge, to allocate your money into the assets that they think will be safe and profitable. But after several decades, the academic researchers find that because the financial market is too complex, Even the professionals do not make good profits. Sometimes the managers, yes, they make higher than average profit or return, but they also charge fees. So the after fee return of your investment is lower than the market average. Then why do you hire a mutual fund manager to manage your money? You can just invest in the market average. And you just need a rule. You don't need a person. You don't need a manager to really manage your money. So people create the ETF, exchange traded funds. That is, I tell you, okay, I will use, for example, the example that I made before. I use your money to I divide your money equally to 300 parts and use each part to buy one stock. So these 300 stocks will make a portfolio. It's a basket. It's a collection. So I just buy it. No person is in charge of it. It's just a computer managed system. Okay. Some people say, I don't want to buy these 300 Chinese stocks. Can I just buy all of the Chinese banking companies' stocks? They say, yeah, we can create another ETF. I'll just give you a list of all the Chinese banks. And when your money is poured into this, is invested into this fund, it will be automatically allocated to this Chinese banks. Other people say, I want to use my money to buy all the East Asian banks. No problem. Create another list. While in the other funds, non-index funds, with the managers, the managers will allocate their portfolio. For example, they find that, okay, this is COVID-19. We probably want to sell some. Airline stocks or tourism stocks, and buy more medical stocks, medical service stocks, to realize higher return. Yes, this sounds very reasonable, but the academic researchers find that the future changes much faster than anybody can expect. For example, after you make the reallocation of the assets, then there is a news. The vaccine has been developed. That the medical service, a lot of medical service, the uncertainty is reduced. The medical service company's stock price will go down, except those who developed the vaccine, and the tourism and airline stocks returns may be higher. You never know. So in the end, probably your reallocation cannot beat the market. We say beat the market, meaning that you have the return higher than the market average. Okay. MSCI is a very famous collection of ETFs. So MSCI has different. This is a company, so it has a lot of different ETFs. Let's turn to the hedge fund. The difference between mutual fund and hedge funds are, first, mutual funds, they're large. Hedge funds are relatively small. Mutual funds are inflexible. They have to, ex ante, they have to notify the investors what kind of assets they are investing in. For example, the mutual fund have to tell the investors, we invest in the Chinese stocks. Now after that, you cannot use the money to buy the Japanese stocks. You cannot use the money to buy the Chinese bonds. You have to limit your choice of assets within the concept Chinese stocks. But the hedge fund is different. Hedge fund managers can do everything. You can buy and sell Chinese stock in the morning. Sell and buy the American bonds in the afternoon. All depends on you. So it's very flexible. But do you think hedge funds, if it's so flexible, why don't a lot of people buy the hedge fund? First, because a lot of people want uncertainty. In hedge funds, the performance or the return of your investment purely depend on the hedge fund managers' professional performance and knowledge and assessment of the future risk. As, as a small investor, if you invest in a mutual fund, your expected return can be expected because you know that all of your assets are in the Chinese stocks or American bonds. You know that the upper limit and lower limit cannot be too high or too low. It's within a boundary. But if you invest your money into hedge fund, you have no idea. Maybe your return will be 10 times high. Maybe your return will be zero. You lose all of your money. It's all possible. So that is why the US government and a lot of governments require that the laws require that the hedge funds cannot make advertisement to small investors. The hedge fund can only do private communication with large investors or rich people. So if you have $500 million, the hedge fund will talk with you. And because they cannot make public advertisement, the hedge fund managers will not talk with the small investors because the same amount of time they spend on talking with some people with $4,000, they could rather talk with a millionaire or billionaire to get more investment. Because hedge fund is more flexible and therefore riskier. So the government only requires a hedge fund to attract the rich people, rich investors who have more ability to bear the risk. Because if small investors lose a lot of money, this will cause potential social instability. Because these people will have no way to live. If they only have $4,000 and you make them lose $3,000, they probably will be crazy, seriously, if you are in their position. But if someone has $4 billion and the hedge fund manager, because of a mistake or some accidents, some special risks that the managers cannot expect, the billionaire lost $3 billion. He still has $1 billion. So he can still live well. He will not make any trouble for the government. So the hedge funds are more for the rich and high net worth people, and they're riskier. Mutual funds are more for the small investors. There are also different kinds of hedge funds. World famous ones include Renaissance, GSAM. GSAM was Goldman Sachs Asset Management. I think now it's separated after the 2008 financial crisis because of the new law. So they're separated into the independent company that does not have. I think they renamed themselves, and they don't have any financial relationship with the Goldman Sachs anymore. Bridgewater, Paulson, and AQR. A very brief introduction because you can basically Google or search online their information. Renaissance was formed by a bunch of scientists. Okay, James Simons is founder. James Simons was a very famous mathematician, and his theory was widely used in the string theory in physics, and he was a very famous co-author of the Chinese mathematician Chen Xingsheng. You not sure, like, because you're a younger generation, I don't know whether you're still familiar with his name, but my generation, the people in my generation are very familiar with Chen Xingsheng. So Chen Xingsheng was a co-author with of James Simons, and in late 1970s, James Simons, and in the early 1980s, James Simons did not want to do the mathematics anymore. So he asked to change the engineering. He said, like, I want to do either politics or business. What's your advice? Change engineering says, I think politicians are very, very smart, and there were a lot of tricks. And as a mathematician and who are very straightforward, like, I don't think you can handle politics. You better do business. And James Simons made the Renaissance. Well, there were a lot of companies called Renaissance, but I'm talking about the fund, the hedge fund, Renaissance. So they have been doing very well, and James Simons himself is a billionaire. You can search and you can find a lot of videos online about the introduction and the interview with James Simons. Bridgewater, you can search for one book called Principles. Principles is the founder of Bridgewater's book, and it's very good. So I suggest you to read it. It was the most, in the past several years. For several years, it was most profitable hedge fund in the world. Paulson, John Paulson made a lot of money during the 2008 financial crisis and 2009, because when the whole market fell into the craziness of chasing the high trend, the increasing trend of the stock index, he said he predicted that the market will crash. So John Paulson short sold a lot of financial asset and made a lot of money. And I heard he donated money to Harvard, donated a building to Harvard, if I remember right. AQR now is it's a hedge fund, but it's more like a mutual fund now. So AQR also had a lot of scientists and PhDs. They're more research driven. Okay. So these are the most famous hedge funds in the world. So the hedge funds also have different types. Proprietary trading firms, for example, Jane Street. Jane Street uses OCaml. OCaml is a special trading programming language. They use OCaml to write their programs. Other companies, they either use C, C++, SAS. No, I'm sorry, it's not SAS. The Python, Java, or some other languages. But Jane Street is very famous for using OCaml, because OCaml is the language, the programming language is very concise and short, but it's also very difficult. Proprietary trading firms are those firms that do not receive the outside investors' investment. That is, I don't need your money. I just trade my own money. It's a more advanced version than a retail trader. If you have only $1 million, you're probably not a big trader. But you have $10 billion, and you want to use this money to hire a lot of talented people to trade the money, to make profits, then this is a proprietary trading firm. Quant trading firms. So these firms do not use personal assessment to allocate the distribution, their different financial assets portion in their portfolio, in their collection or basket of the financial assets. They more rely on the computer programs. They use computer programs to set a rule. For example, when the stock price is higher or is increasing for successive of 5 days, I buy or I sell. If something happened, for example, if there's some news from some country, I sell that stock. They set up the rule in the computer system and let the computer to trade the stocks or other financial assets. So they rely more on the rules rather than humans' intuition and humans' personal assessment. They're quantitative trading firms or quant trading firms. Famous ones including Two Sigma, Tower Research. There was a famous company called the SAC, but now it was sued by the American government. So it was reorganized into .72. Okay. These there were also other types of hedge funds. These hedge funds types they are not mutually exclusive. That means a company can be a proper proprietary trading firm and also a quant trading firm. For example, Jane Street. Okay. Uh, the hedge fund they have a lot of different trading strategies. You will learn it later in the other financial courses. For example, momentum is a trend chasing strategy or a mean reversion. Okay, this is more for the long run investment. They trade different assets, for example, equities. By the way, stocks or shares, they have another name called, or more professional name called equity. Equity. Finance is such a major discipline that involves a lot of different names for the same thing. Okay. This is, I don't know, but if you're not familiar with these terms, it's very easy for you to think someone is very professional just because they know a lot of different terms. But in essence, they are all very easy. Okay. So the hedge fund, they can trade the equities. They can also trade FICC. FICC is fixed income commodities and currencies. Okay. Or MBS. Mortgage-backed securities, or some other ABS, asset-backed securities. You will learn this later. Maybe not in this course. The third type of buy-side companies is called private equity. For example, Blackstone. A lot of people confuse between, the outsiders who are not major in finance, they're confused between the Blackstone and BlackRock. BlackRock is a mutual fund. Blackstone is a private equity fund. Private equity funds have different types. But mainly, a private equity fund is sorry, I was interrupted a little bit because some people were talking outside, so I told them to be silent. The private equity has different types. The most famous one is called VC, or venture capital. So venture capitalists, they are giving money or they're investing money into some very talented person or organization. For example, SoftBank, a Japanese investment or VC, invested in Jack Ma, the founder of Alibaba. In our world, there is a mismatch between capital and talent. There are a lot of people with great ideas and great talent, but they just don't have money. And a lot of people have a lot of money, but they just don't know where to invest. So VCs connect these two type of people. So they find the rich investors and say, you give me your money to us, and we use your money to search for the very talented people. So the VC, venture capitalists probably will see 2,000, 3,000 different projects and compare them and decide, okay, I think this idea is very, very talented, and moreover, and more importantly, it is feasible. For example, if I say, I'm a finance professor, and I have an idea of investing, of innovating equipment that can ship me to Mars. Would you think anyone would invest in my idea? No. They don't think I have any capability of doing this. But if I say, I have I know some financial softwares can be updated, and I can make better teaching softwares, then some people may be thinking of investing in me, my company. They not only for the feasibility and the ideas, they also think about whether this can be profitable, the future market. Okay. This is a VC. Usually, 90 or 99% of VC's projects will fail eventually because it's really, really extremely difficult to turn an idea into something useful and profitable. But if just 1% of the investments can be successful, then the VC can be profitable. The research revealed that the VC's total profitability is not as high as people usually think because of a lot of failed projects. So when the private equity or VC invests in a talented person, they will make a contract. The VC will be a limited partner, called limited partner. And the talented person or organization will be a general partner. So they probably will say, hey, we make the contract, the VC will give you $2 million. And you have your idea, talents, and probably the patents. So the general partners, they have 80 or 70% of the ownership of this company. The limited partner, the VCs give $20 million and say we have 20 or 30% of this ownership. So in the future, the VCs probably will sell these shares to another VC, or eventually go to the IPO, sell the shares to the public investors to profit. These $20 million in the future, maybe $20 billion. Okay, or it can be zero if the company eventually fails. This is VC. There is another type called LBO, leverage buyout. The leverage buyout firms are those firms who think they have very good, unlike VC, they don't have very good professional knowledge to identify very, very good investment targets at the early stage. But they have very good management skills. So they usually think, okay, this is a publicly listed companies. These publicly listed companies have a lot of management problems. The CEO is stupid. CMO is stupid. CFO is stupid. Everyone is stupid. If we take this company, we can turn it into a very, very profitable company. So what they do is they use leverage. What is leverage? In finance, leverage is a term meaning borrow money. Borrow money. So they leverage, meaning that they borrow a lot of money. They borrow a lot of money and use this money to buy all of the outstanding shares of this public company and make it private. So a company is already publicly listed. It has maybe 1 million shareholders. This company uses a lot of money that they borrow to buy all of these shares and turn this company private. And they just manage this private company and make it from losing money to be very profitable. Then make this company public again. Then sell, so they turn the stock, this company's stocks with no value or very little value into the stocks with higher value. Then they sell the stocks again to the other investors to profit. So these people have very, very good management skills. And, well, KKR is one of the very largest LBO firms in the world. There is a very special type of LBO firms that is MBO, called management buyout. Management buyout. Okay. LBO, the people who buy out this firm, public firm, and turn it into private, they can be outsiders. They can also be the insiders. MBO is for this situation. This group of people, they are management people. They are the managers. They are the CEO, CFO, and CMO, and the other people. They only think, hey, we are in charge of this firm, but we don't really have incentives because we don't have stocks. If we make this company very profitable, we don't get anything. Okay, we only have the salary, or maybe 1% of the stock. Why do we work so hard? But we want to work so hard because we know how to make this company good, and we want to get a larger share. So, as a management team, they borrow a lot of money, leverage. They take leverage and they borrow a lot of money, and they buy out their own company. Well, we cannot say their own company. They buy out the company they themselves are managing and turn this company their own companies. And they manage this. They have more incentive to make this company more profitable than the stocks with higher values. There were other private equity firms. For example, they invest in the distressed debt, and there is one that I didn't say. This is mezzanine debt. These are more complex concepts. If you have interest, you can take the internationally recognized CAIA test, the qualification test, and you will learn all of this in detail. Okay. There are also retail traders. Who are retail traders? If you have a stock account and you trade your stocks on your phone, over your phone, then you are a retail trader. If you have like $4,000, you are a retail trader. If you have $4 trillion, you can't have $4 trillion. If you have $4 billion, if you are really rich, you are not a retail trader. Even you are just one person, you are also an institution. Okay? You are a high net worth person. Okay. So retail traders are usually for the we are talking when we talk about the retail traders, we're talking about the small traders with not so many financial assets. Okay. Note that the financial service firm may have multiple arms of these above services. That means a firm can have both the private equity and the hedge fund. Some firms also they have the VC branch and LBO branch, or VC branch and the quant trading firms branch. They can have multiple arms. Okay, this is the buy side. Let's take a break and get back in 10 minutes.